We are now joined by Mr. Sanjeev Bhasin, Executive Vice President, Markets and Corporate Affairs at India Infoline Limited, who is joining us here in New Delhi. Thank you very much, Mr. Bhasin, for being with us here on NDTV. I want to talk to you about the capital goods space and specific sectors as well. But before that, for Nifty, we hit 7,700 for a very brief moment, and now Nifty has slipped below. But you know, the kind of movement that we've seen in the market, in just last 1 week and since the beginning of March, are we on an upside path from here?
Well, Sweta, they say a month makes a lot of difference in the market, 21 days, and from extreme pessimism, now we are in so much optimism that at that time, even if a pin fell, the market would fall. And here you have, again, terrorists striking in the worst unfortunate incident, and the market's not even giving 20 points. So the undertone has changed. It's become a bull. It's in the making of a new bull market, and any dip is being bought. FIs are aggressive buyers. Bond yields are at almost 5-year lows, and the rupee is very, very safe. So to put your point in perspective, we think maybe the market in the short run is overbought. You could see a correction, and we have 3-4 days holidays, and next week is expiry. You could have a shot at maybe 7,400 in the next 10 days. But the undertone is extremely strong, and everyone is now looking forward to the RBI policy and the ambit of the result season. So I think the market could be range bound for some time, but we think in April definitely a shot at 7,900 to 8,000 is on the cards. And if I give you a slightly longer view, Shweta, Henna, I think year-end target, we were one of the few at 7,000 who said that 31st December 2016 Nifty will be 8.5 and 9,000 between that. And I can stick my neck out and say that 1 year forward, 31st December 2017, Nifty could be closer to 11,000. So I think August, September onwards, we are at the cusp and beginning of a new bull market, which will be for almost 2.5 years, and where I think as an asset class, equities will outperform.
That's a good news, of course, for long-term investors who are probably putting in money into the equities and probably buying on every dip, as you've been telling us from time and again. But when we're talking about an 8,500 to a 9,000 sort of a level and then 11,000 next year, what are we factoring in terms of the oil prices, which have played a very important role? What are we thinking of as far as the demand scenario is concerned, the global demand? IMF, World Bank, all of them have been cutting global growth forecast for 2016 and 17. So are we likely to see all that really getting better as we move ahead?
Yeah, Hina, I'll give you 3 indicators. 3 of the worst performing asset classes: steel, PSU banks, and in the emerging market basket, the Bevespa. The Bevespa on 26th January hit 37,000. Yesterday it was 51,000, up 30%. The PSU bank Nifty and the metals index is up 25%. And China itself is on a roll in the sense steel prices are up 24%. So I think a lot of the pessimism got overdone in the first 2 months. And I think the market is now factoring in the second half of the year, a cyclical rally where metals, and that's the proxy which metals are telling you. And I think India will be in a sweet spot because for us, oil at this $40 is much more better position than oil at 30. Then we are seeing offshoots of green shoots emerging on the manufacturing side and the government policy on a number of steps on coal, power, on capital goods. And thirdly, interest rates on a lower regime. The RBI now 25 basis points is in the bag. It's whether it can do 50 and maybe another 25 in the next few months, which will actually improve bottom lines tremendously. And we think in the second half you should start to see double-digit earnings momentum starting to pick up.
Okay, so that's quite a hopeful, rather optimism that you're talking about going forward as far as the next quarter earnings are concerned. You're considering a 25 basis point rate cut, but if you do see a 50, I mean, if the RBI governor does manage to surprise us the way he's been doing all this while, last time the way we got a 50 when we were all expecting a 25 at least. So if that happens, do you think that will further be a bigger trigger for a rally in the market?
Well, then 79 to 8,000 is on because most of the participants think that the RBI will be tight-fisted and maybe 25. But like I said, the repo at 6.75 is now due for 6.25, and the bond yields at 7.5 are telling you that there is a 40% chance of at least a 50 basis point. And Hena, that will actually strengthen the private capex, which has been the lag. It has been government spending and government capital expenditure which has been pulling the market and the GDP. We think capex, private corporates will now start to spend more and enhance capacity. That will be the icing on the cake.
Right, and here I want to talk to you about the capital goods space particularly. Today in the cabinet, the capital goods policy has got the clearance. We're yet to see some details on it, but government has got big hopes. Capital goods sector in the last couple of quarters, if I may just say, it has been facing a severe slowdown. We've been seeing that in our IIP numbers as well. Do you think this is the time to probably consider some of those capital goods space, considering this policy is now going to be in place?
Yeah, so we can talk about stock, but look at the fundamentals. First, they started on coal, power, and the other infrastructure, which was in a bottleneck. All that now being done, now they are focusing on PSU banks, getting down IDBI below 51, merging a lot of the others, and open to the idea that a lot of the other PSU banks can also be put up for disinvestment below 51. Air India being sold 49%. So the government is doing a lot of steps on the positive, and I think what was due was now on the capex revival to get these capital goods stocks to move up. Already yesterday a CLSA report has said that the power sector order backlog now, which is now being unleashed, is going to be one of the, BHEL will be the biggest beneficiary. Secondly, they've also put a cap on Chinese exports, which has been the bane of the industry. And thirdly, if the whole Make in India theme is going to be played out, then capital goods stocks have to participate. Now in that basket, you can have, we've been very, very positive on L&T and BL. And we thought that L&T would be a biggest beneficiary of this defense and capex revival in India, even though it had a lag because of the Middle East business which was suffering because of the weakness in oil. So BEL, L&T, ABB, Siemens, these are four of the big names on the spot which we have been bullish on, and we continue to be buyers of this on any dip.
Right, and what's your view as far as the public sector banks now are concerned? As you yourself mentioned them twice so far, the kind of focus that government has been making. Now we are hearing consolidation may really come in sooner than later. Is it the right time to look at some public sector banks, or should we still be going forward to and look at private sector banks instead of public sector banks? What's your view?
Yeah, so Henna, if you recall around that time when there was fear so high and State Bank was 150, we were one of the few who was sticking out and saying that most of the bad news is overdone on the price front. Now, of course, State Bank has rallied 30% from there, and we don't want you to buy it there. But some of them have already overplayed on the NPA side. And if you thought that steel sector has been the best bounce back in this quarter, then I think provisioning numbers on NPAs are going to be fairly low, and you might see some icing on the cake on the upside. Along with that, bond yields at 7.5 tell us that government securities mark-to-market treasury gains are going to be huge. And thirdly, government committing to recapitalize them is another positive. So yes, they've run up far too fast because of short covering and some inform-based buying. So we would use any decline in some of the key stocks to buy. Stocks like Bank of Baroda, State Bank, Canara Bank and PNB would stand out, but on a decline, because right now they've run up very, very sharply, and we think the results of one or two of them could be slightly disappointing. So that you wait for those disappointments to accumulate these stocks.
Right. Also, I wanted to get your views as far as the steel sector is concerned. Today, we were talking about a report that Citigroup has come out with, saying that one should be very cautious because of the kind of up move that we've seen in many of these steel stocks in the last 1 month, 12 to 20% higher. How would you place your bets on the steel sector?
Well, steel is a proxy to the market. In this type of pullback, I think 75 to 80% of the people have missed out. And you before you waited for a correction, the market was low, and behold, it was up to 7,500. So this is called khate angur, or we say sour grapes. Most people have stayed left out, whether it's steel or whether it's the general market, and everyone is hankering for a correction. When that will come, we will see. But right now, everyone wants to put out reports where they could get some sell ideas. So I think yes, the steel sector, the results may take 3-4 quarters to play out, but markets are forward-looking barometers, and if you saw stocks like Tata Steel or JSW, they are already priced in the worst of the downside which was there. On the other hand, the minimum import price by the government, China putting a caveat on a lot of their production capacities, and now steel prices rebounding quite smartly, tell us that the bottom lines will be starting to accreditate positively, but results are always a lag indicator. It may take you 2-3 quarters. So we are positive on a few stocks over there. To name a few, Tata Steel and JSW on the steel side, and Hindalco on the metal side. We think these three can be standout outperformers.
Right, so that was a summary of what one should look forward to as far as steel banks are concerned. Now I want to shift focus to the pharma space, which has been really the story last week and this week as well. Let's start with Cadila. It has lost about 5% yesterday. Today it's down over 1% as well. Do you think it makes sense to buy it right now at these levels?
No, for us, pharma is an avoid, and unfortunately, this is the story of the market. Beginning 2016, everyone was overweight on pharma, and the best short candidate was PSU banks and steel. And if you've kept those positions, you've been losing money both sides. Steel and PSU have been the biggest outperformers, and pharma, which is a defensive sector, has been underperforming miserably. So for us, I think the best of pharma may be behind us. And it will take a lot of effort for this FDA, stuff to get approvals to come back, a lot of work to be done on the manufacturing facilities, a lot of pressure on contract farming. There is a whole host of negatives which are built up. And for a change, this sector, which has been a low beta sector, is now turned high beta on the downside. So for us, it is going to be, if I name the stock, Cipla is a very, very key buy which we have, because of the inherent business which is had locally and the progress of Astelin Elenor as a whole in Europe. So they could be specific stocks, but for us, overall pharma would be an avoid.
All right. So overall pharma will be something that you would want to stay away. What about Lupin? I mean, even that stock has been in focus. It didn't really factor in your list. So does it mean that one should even not really look at Lupin at this point in time?
See, the moral of the story is what happened to a Dr. Reddy. The bluest of blue chip fell down 30% and you didn't get a time to exit. Now, whether it's Lupin or it's Walk Hard, you have a lot of these high beta plays. I know Lupin has been a pedigree stock, but recently I think the disclosures and some of the FDA observations have been fairly negative, and we have not priced in the worst, So I don't see any reason to buy a stock which has fallen 18% when the Nifty is up 10%. I would rather wait and let more clarity come out. And like I said, there is a whole host of outperformance which can come from the broader market, which includes some of the mid caps which are outperforming and some of the larger plays. Because if the Nifty is going to go much higher, it's going to be the broader market which will participate, not just, a handful of pharma stocks.
Right, and before we wrap up, I also want your views on the sugar sector. I mean, something that has been buzzing as well. Not many people really talk about it too often unless there is some or the other trigger. We've been talking to the managements. The indication that we are getting is that FY16, according to them, is going to be a turnaround year for the entire sector. Do you think it makes sense to probably look at that basket as well?
Well, sugar bottomed out way before any other asset class in soft commodities did. And, almost 2 quarters back, sugar started to show a lot of accretion, and the stocks have been multi-baggers. So, we've been focusing on one of the top line stocks, that Balrampur Chini. We think that's in triple digit. We recommended close to 65-70. We still think this is a pedigree stock. The management is par excellence. And we have another name like DCM Shriram Industries, where there's a consolidated play on this, and there is also a lot of other businesses which have moved profitable. A third name would be EID Parry, where again we think the management and the business, particularly the area which they suffice to, is very, very profitable. So these three names stand out, but please not now, because I think they've run up far in excess of because of the momentum. You should look for some bad news, so maybe some of the results below par, and that would be a good time to enter.
All right, Mr. Bhasin, we'll leave it there. But thank you very much for joining us here this afternoon on the last trading day of the week and giving us interesting ideas as to what are the key sectors, of course, one should be looking at. And definitely some interesting names have come in. But more important was the level that Mr. Bhasin really mentioned for 31st December, 8,500 for Nifty to about 9,000 and 11,000 level for December 31st, 2017.